Good morning, and welcome to this week's What's Affecting Oil Prices. I'm Ashley Peterson, lead oil analyst here at Stratus Advisors. In the week since our last edition, Brent prices fell slightly, averaging $64.95 a barrel. For the upcoming week, we expect Brent prices to be somewhat range-bound, averaging $65 a barrel, with the Brent WTI differential remaining around $3.50 a barrel. Geopolitics will be a neutral factor in the week ahead, with little news on the geopolitical front that is likely to influence prices. The dollar will be a neutral factor in the week ahead as fundamental and sentiment-related drivers continue to have more impact on crude oil prices. The dollar moved sideways last week as crude oil rose slightly. Crude oil will likely remain only marginally influenced by DXY in the week ahead. Trader sentiment will remain a supportive factor for crude prices in the week ahead. ICE Brent and NYMEX WTI managed money net positioning both fell slightly last week. Short selling also indicates that producer-level hedging has ticked up in recent weeks as producers take full advantage of recently high prices before a possible correction. Supply will be a negative factor in the week ahead as U.S. production continues to increase. According to Baker Hughes, the U.S. rig count fell for the first time in 6 weeks last week. However, such fluctuations in rig numbers are common, and we do not believe that this is the start of a trend. Libya has been having trouble keeping fields online in recent weeks due to protests, which has reduced production slightly. However, evidence of renewed global oversupply continues to pose the greatest threat to prices. Demand remains a positive factor and is generally strong, although with product stocks draining, demand is not providing as much support to margins and thus crude as would be hoped. Global refining margins fell across the board last week, with the largest decline seen on the U.S. Gulf Coast. Declines in margins appear to be slowing, and we could even see some strengthening in margins in the weeks ahead as Asian refinery maintenance is underway. However, in the meantime, margins are not robust enough to incentivize additional runs of a level likely to support crude.
This weekly report is an excerpt from our short-term price outlook service analysis. For more information, please contact us.
To stay up to date on the most recent Hart Energy videos, subscribe to our YouTube channel by clicking here.